I had discussed the concept of hmm, sunk cost and unavoidable fixed cost, that is committed fixed cost. So write down unavoidable fixed cost slash committed fixed cost. The cost which cannot be avoided. The cost which cannot be avoided. Now, strike it off. Yes. The cost which will be incurred in the future. The cost which will be incurred in the future. But the cost which will be incurred in the future, but it is unavoidable slash committed in the short run. Full stop. It is an irrelevant cost. As the cost cannot be changed because of any course of action taken. Full stop. You guys have watched last 1 hour's recording yesterday. Most of you will get confused heavily today. This is a separate topic. So there is a difference between sunk cost and unavoidable fixed cost. Sunk cost is in the past. Unavoidable fixed cost is in the future. But why they are irrelevant? Because they, no matter what you do, you cannot influence them. In finance, decision making is based on factors which is within your control. These are factors outside your control. These are non-controllable in a way. Third is a very simple thing. I don't have a name for it. I just write it this way only. Third irrelevant cost. carefully. The cost which is same in all the available courses of action is irrelevant in decision making automatically. See, I'll give you a very simple, and this will not be a very detailed example because I have to move ahead as well. I told you I live on rental accommodations. I've always lived all my life. I've been here in this city for 5 years now, and I have lived in 6 different rental accommodations. Every 11 months, I start a new search. So let's say I went outside and I shortlisted 3 properties. Shortlisted means I finalized that I'll be moving in either one of them. 1, 2, and 3. I analyzed the rent of all 3 properties was 20K. Exactly. Now, tell me whether I move into property 1, property 2, or property 3, will that have anything to do with the rental amount? It becomes irrelevant. This is the third irrelevant cost because no matter where I go, the outflow will be same. So I will choose it based on other factors, maybe the amenities, what they are providing, power backup and everything. Maybe I will choose it based on security deposit. But this becomes automatically irrelevant because it is same in all the available courses of action. Are we clear? These three are more or less what we call as irrelevant cost in finance. In part one, only one topic, transfer pricing, depends on it. Part two, every topic depends on it. Because this is how core finance works. Finance is decision making. Decision making is something else. Accountancy is calculating profit or loss as a result of decisions made in finance. That is why financial positions always, actual financial positions, always offer way higher pay because that involves decision making. You get paid for making decisions, not for following them. Now, these three are generally what we call as irrelevant cost. Now, let's talk about relevant cost. There are three relevant costs. One is variable cost slash marginal cost, more or less same thing. I think I already explained it in the first class what is a variable cost. Generally, it is always a relevant cost because it is an out of pocket expense. So, yes, whatever decision you take, this money will go out actually. So, this is generally always a relevant cost. Second is avoidable fixed cost. Is it done? Now, understand, I was giving an example for unavoidable fixed cost or committed fixed cost that your friends has booked movie tickets. You have to pay whether you go or you. But there are other fixed costs also if you turn up. Maybe cost of transportation. maybe some other cost. Or think about if friends are going for a trip together and flight tickets are already booked. Now, whether you go or you don't go, flight tickets are gone. But hotel and all is not booked. That will be booked once people reach over there. So that is also a fixed cost because hotel cost is generally not variable. But that can be avoided if you decide not to go, or that will be incurred if you decide to actually go. So this is a cost that can be that is still within your control. You can still influence it with a particular course of decision that you take. Unavoidable fixed cost, flight tickets are already booked. You can do nothing about it. Money has already gone. And right now, to still 3 days back, DGCA has passed a rule that if you cancel something 48 hours before or something, they will not charge you extra. Otherwise, you don't get 10 rupees back also if you have booked a flight ticket and you are canceling. 70-80% will go away. We are left with nothing. But that is a committed cost. But this, if the rental place and everything is still not booked, that will still be a fixed cost once you end up there. Of course, variable cost will also be incurred over there. Cost of food, cost of traveling. But this will be a fixed cost. You can avoid if you don't take a particular course of action. This is an avoidable fixed cost. You have a shop. That shop is running well. You suddenly decide, and you have a go down. You suddenly decide to start another business. And what you decide that you will use your go down as the place of, or sorry, you will use that go down for that shop. And that go down, you'll move somewhere else maybe. Of course, go down again, you will have to rent somewhere else. Avoidable fixed cost. Because if you don't start the business, the money will not be spent. You have to understand finance is not like costing. There are no fundamental rules that govern. There are fundamental rules that govern accounts and costing. Finance is about logic and application. In part 2, you will learn everything that CA intermediate students learn. Everything about finance. Something more also that is there in CA final. You will learn that as well. Bonds, equity, derivatives, call, put, hedging, futures, capital budgeting. But this is only a part. Transfer pricing is comparatively easy. Once I'm done here in 3 examples, I will wrap it up transfer pricing. Now, third is, I hope most of you would have heard of it. Who will explain me what is an opportunity cost? Commerce background students? They should be able to explain something about this. I'm assuming most of you have heard about this term opportunity cost one time or another in your life. So explain me what that means if you are from a commerce background.
The spending of cost is considered a the spending of the cost is considered by the decision for opportunities.
Okay. People generally have answer for this. Right or wrong is irrelevant. Okay. Okay. What is he doing? Where are you lost? This is little weird because I generally get lot of answers for this. Mostly wrong, but still I get them. Commerce background students are taught this. His answers was closest to the correct one. He just forgot one word, best, a benefit. But I'm assuming he knows the answer. He messed out one word. Now that's acceptable. But commerce background students are supposed to know this. It's taught in the first semester only or second semester only. When you are attending your colleges, listen. Those are PhD professors trying to teach you something. Try to learn. College lectures are not merely for attendance. They are also for learning something in college. If you are going in college with a view of gaining only attendance, you have wasted your time, not college's time, for 3 years. Because here I get lot of answers. Entire commerce background students will give me answers. Right or wrong is irrelevant. The benefit foregone from the next best alternative. Oh, this should not have been there. The benefit foregone from the next best alternative when selecting a course of action from multiple alternatives. Let's say, Mr. Write it down later, but first understand. One thing I would really like to tell you guys is when you are really who are still students and who are studying in colleges, try to study while you are there in college campus. Do not use your cell phones inside your classroom. Deceiving your teacher will not do you any good. You are harming yourself only. And try to listen to lectures. Every teacher has something to teach, and those are PhD qualified professors. If you are going in with the view of purely gaining attendance, it's worse than rote learning because you don't know rote learning also properly. You don't know theory, you don't know practical. That's worse than knowing theory. At least those who do rote learning knows the bookish things totally well. They cannot apply it in practical life, that's something else. But if you don't know book also, you don't know practical life also, that means you are zero. And everybody will not be explaining like this. Every teacher you meet in your path will not explain everything like this. Not trying to do boasting or something. Some teachers can wrap it up quickly also. Assuming you are commerce background students, you are supposed to know this concept. So especially those who are still in colleges, go to college with the intent of learning and listening. Do not go with the intent of using cell phones inside your under the tables where you are sitting, texting your friends and all. That does not help at all. Because if you can be sincere here, you can be sincere in colleges as well. Every professor has something to give. Every professor and every class, something to it will be there. Mr. X has 10 lakh rupees to invest. He has three alternatives available. Option 1, invest in FD, 7% expected return. Option 2, he can start a business. 12% is the expected return. Option 3, invest in equity. Expected return is 17%. So I'm jotting down the three returns. So 10 lakh into 7%. If he goes with option 1, he is expected to make 70,000. If he goes with option 2, and if he goes with option 3. Now, what is opportunity cost? See, money is always limited, and you can always do a host of things with that money. Opportunity cost is the cost of opportunity because you are doing one thing, you cannot do the second thing. So the benefit lost, that is the meaning of benefit foregone or benefit lost. The word here, the simple word here is, technical word is foregone. The laziest word is lost. Because you did A, you could not do B. From the next best alternative, what was the second best option? Huh? Sorry? Somebody spoke something? What was the doubt? Tell me. Or if you have a doubt, tell me. The benefit lost from the next best alternative. You can have 10 options. But when you are talking about benefit, you are considering the benefit lost from the second best option. Is called the opportunity cost of choosing that option. Because you went with option 1, you could not went with 2 and 3. And what is the best thing you lost there? So if Mr. X decides to go with option 1, he is losing out on 2 and 3. The higher benefit is in 3. So the opportunity cost of going with option 1 is 1,70,000. Why will he still choose it? Part 2. Risk and return go hand in finance. Lower the risk, lower the return. People want to protect their capital also. If he goes with option 2, again, if he goes with option 2, he starts a business. Now he cannot do FD or can invest in stocks, equity market. Now again, I have to look for the next best alternative. So out of these two, the best option was, if he decides to go with option 3, Vignesh, what is the opportunity cost of option 3? How can you be the same? If he decides to go with option 3, he's so going with equity. What is the opportunity cost? You are telling 1,70,000 only. That is the difference. 1,20,000. These are all expected returns, not actual returns. Nobody knows the actual returns until the end of the period. Who told you equity market will guarantee 17%? It's an expectation. So yes, option 3 always has an opportunity cost. If he decides to go with equity, he neither can do a fixed deposit nor can they start a business. Better alternative among them two, those two was starting a business. So he has lost out on that opportunity. So there is still opportunity cost attached here, because see the word I have used, expected return. Actual return is not known until the end of the period. These are all expected figures. If everything was known, so I would have went with option 3. Why would I have even considered option 1? It's a very simple thing. If you know that you will make 17% in the stock market, why will you invest in FD? No, this is all expectation. An investor is evaluating all of them to understand where to go. The cost of option 1 is there, 1,70,000. Cost of option 2 is also there, 1 lakh. But the most important thing is there is cost of option 3. Because they went with option 3, now they cannot do either 1 or 2. And they lost out on the higher benefit. Next best option was 2. There is an opportunity cost. In finance, everything has an opportunity cost. Even the time you are spending here doing this class right now has an opportunity cost. You could have done X number of things with this time. Like yesterday, some of you chose college. Maybe today it's no college, so you could have slept, watched a movie, go out with friends. The next best thing you could have done with your time right now is the opportunity cost of this class. Everything has an opportunity cost in this world. Again, the time you spent on lectures, using your cell phones, and I know it because again, I've been to every college in the city. Colleges change, names change, behaviors don't change. That has an opportunity cost, your future. Because they are teaching you, you are not listening anything. You somehow pass because you are aware you study past papers and all. 30 marks or 40 marks is internal only. But that holds no value because you know nothing. So that also has an opportunity cost. Everything has an opportunity cost in the world of finance. The time you decide to bunk a lecture to go out with friends, again, if that lecture is important for your future is the price you are paying for that time. So everything has an opportunity cost, and this is a very important concept. Without understanding this, if you hope to make a career in finance, not possible. You can still have a career in cost. You can have a career in accountancy. You cannot have a career in finance without understanding what is opportunity cost. So next time when you take a decision, understand the opportunity cost of that decision, because it's a very layman's concept. If you study any great investor, they will tell you what everything has an opportunity cost. Everything. Is it clear? Note it down quickly. Is it done? This is a chapter again. If you understand the concepts, it's way too easy. If you don't understand it, you will only try to memorize. Everybody has noted? Now let me start the chapter. As I was discussing yesterday, it's transfer pricing. Section C, B was done yesterday. Now, transfer pricing. This is also taught in direct taxes and all, in chartered accountancy and ACCA, but at final levels. But that is something else. We are going to talk it purely from a costing perspective. There are three examples I will give. Focus on them very carefully. Actually, not even three required. Two is more than enough. Listen very carefully, because if you can understand these examples, the chapter is a cakewalk. Otherwise, it's your nightmare. And I'll dictate everything. Do not write down. I said I will dictate. Because I have not even started, I will dictate it thoroughly. X limited has two divisions. If you are writing it down, leave six lines on top of it. तब लिखो. Because I have just written X limited to remind myself that I have to dictate it thoroughly. This is just a table I am creating right now to explain. Hmm. Again, there is a lot I will dictate. So anything apart from table, you should not write down at all. Table also I might edit a little, but more or less it will be this only. Now, see this. First of all, transfer pricing. When we talk about transfer pricing in this topic, we talk about transfer between one department of the company to another department of the same company. It is not a talk about transfer from one company to external person, interdepartment. The topic is all about understanding what should be the price. There are always three questions that every transfer pricing question should answer. Of course, tax laws are also there. You have to keep that in mind. But that is not in your syllabus. Interested in that? Go and do CPA after this. But so costing rules are simple. We will only talk from profitability perspective. Should the transfer happen? What is the minimum price and what is the natural bargaining range? So here I have taken a company X Limited, which has two divisions, A and B. Capacity of division A is 10,000 units. Currently, external sales of division A is 7,000 units. Selling price per unit, the price which division A charges from the customer is $60 per unit. The variable cost incurred by division A in making this product is $35 per unit. And fixed cost that is allocated, unless the question tells you otherwise, it's always allocated, unavoidable. Fixed cost per unit is 8. Now division B can also use the component that division A is making. What is the units required by division B? 3,000. And the purchase price, of course, an external vendor has quoted division B a purchase price of $48. But since it is within the company, first they would like to check should the transfer happen or not. Now, the first question is, should the transfer happen? Always remember, the transfer should always happen if relevant cost of manufacturing is less than relevant cost of the transfer should always happen or can only happen if the relevant cost, and that is why yesterday's last 1 hour was important, relevant and irrelevant. If relevant cost of manufacturing is less than relevant cost of purchase, because both are part of the same family, if one can make at a lower cost, then what is the purchase price? In that case, they should do in-house transaction. घर का पैसा घर में ही रहेगा. The money of the house will stay in the home only. In this question, relevant cost of manufacturing is only one. There are three relevant costs. So that what is department A incurring? Division A. I'll change this and make this 80. There are three relevant costs only: variable cost, avoidable fixed cost, opportunity cost. Variable cost is here. There is no avoidable fixed cost. If the question is silent, that is all allocated fixed cost or unavoidable fixed cost. That will be incurred regardless of what you do. That is just allocated to the 7,000 units you are producing. Your total fixed cost must be 7,000 into 18. That is $1,26,000. Everything has to be recovered from the customer. So you are allocating it to the 7,000 units you are producing. But will the total fixed cost change as a result of this? No, it is within the capacity only. Capacity is not increasing. So there is no concept of avoidable fixed cost unless the question tells you explicitly, clearly, this cost is always assumed to be unavoidable or committed fixed cost. Opportunity cost, there is no opportunity cost because I have excess capacity. I have excess capacity. I can make 10,000 and making only, and that guy needs only 3,000. So it's not like I have to go back or cut down my external sales to do this business. That's not the case. So relevant cost of manufacturing in this case is 30. You can forget about the $18 completely because that is an irrelevant cost. On the other hand, relevant cost of purchase is the purchase price because that is the money vendor will charge. That is 35 less than 48? Yes. So transfer should happen. Now this much decision I have reached. In one question, they will not ask everything, but I will give you only two examples where I will cover everything. So yes, first question is answered. Transfer.
Again, can you tell about the avoidable fixed cost?
Hmm? There is no avoidable fixed cost given in the question. That fixed cost per unit, they are silent. And if they are silent, you always assume it is unavoidable or committed. So you have to ignore it in decision making anyways because it is unavoidable. No matter what you do, it will get incurred. You cannot, if you increase production by 3,000, avoidable fixed cost has to be something where fixed cost is changing as a result of this in total. If the question, this is just an allocation. The fixed cost per unit is 18 and external sales was 7,000. First day I taught you guys, everything has to be recovered from the customer. So total fixed cost must be 7,000 into 18, 1,26,000 that they are recovering from 7,000 units. But is it relevant for decision making? No, because total cost will not change as a result of this. So I will ignore it in decision making. That's why I was telling you, finance and accounting are two separate worlds altogether. If I teach you part 2, the syllabus of your part 2 is good enough to teach you what MBA finance will.
What is the external sales?
Don't go beyond the scope. I will give another example. One at a time. I know that is my second example. If I do that right now, people will not get heavily confused. So yes, transfer should happen. And transfer should always happen if relevant cost of manufacturing is less than relevant cost of purchase. The logic is very clear. If one part of the company can make it at 35, why should they buy it from outside person for 48? There is no logic. Now, second question was, what is the minimum transfer price? The minimum transfer price means what is the minimum amount that division A can charge division B. See, in corporate, all the divisions look after their own interest. It's not one big happy family. Like in joint families also, everybody has to look after their own numbers. Because at the end of the year, your numbers only decide your appraisal, your rating, and everything else. Your means your department numbers. So in this case, the minimum price which A can charge B is always, and again it's always. When I say always, that means there is no exception to this rule. The relevant cost of manufacturing. I cannot go below that because if I go below that, there will be a loss to my division. I'm making it at 35. The lowest I can give it to you is at 35. I cannot go below that. I cannot have a loss to my department. You will understand there are concepts called as cost center, profit center, revenue center and all. But think of right now, most of the companies, especially multinational companies, give their division managers enough autonomy to take their own decisions in interest of their own division. They will not interfere unless that decision goes against the interest of the company as a whole. So minimum which A can charge B is 35 in this case. Is it clear? Are both the points clear? Third, what is the natural bargaining range? I learned this in CA final. We used to call him the god of costing, CA Sanjay Agarwal. I don't know if sir is still teaching or not. Might be retired. We had seen online classes back in 2012-13 only. Lectures were recorded. The best CA faculties were always in Delhi, are still all in Delhi. So those lectures were recorded, pre-recorded. A projector like this was here, and those lectures were run in something like this of a classroom. A TV was also there so that we could look at sir's face also and what sir was writing also. And 70 of us or 90 of us or 200 of us used to quietly sit and listen to that 4 hour, 4.5 hour lecture. Morning, 6:30. Nobody used to disturb anyone. And we all used to keep our phone on silent mode. No calls possible at all, unless there was 10 minutes, that 15 minutes break time. So it was not impossible back then also, if you want to study. Sir is based out of Delhi. So we got to learn from him in this mode only. Morning 6:30 it used to start. 10:50 a.m. it had to end. Then we had to rush over and start our article shift. Boss is waiting for us also. Sir taught us this. And whichever batch I have taught, I have always credited sir at the beginning. And everybody knows two, three of my favorite lines, which all I use and I credit sir instantly for it. Sir used to always say here that division A will not go below 35 and division B will not pay more than 48. Division A will not agree to any price below and division B will not agree to any price above. So the natural bargaining range is between 35 to 48. Because anything between that benefits both the division. If it is $36, division A is making it at 35 and giving at 36. $1 extra contribution is coming. If it is $37 and B is also happy. If it is 37, still A and B both are happy. If it is 40, still A and B both are happy. If it is 47, then also B has something to show that, see, externally I would have purchased it for 48. Even if it is 47.99, still B is saving 1 paisa, or in dollars it's called 1 cent. The manager can go back and tell to his employees, this, I have done a good deal. Whatever you have watched in TV shows where they show that negotiation means crushing the other side, nonsense. Good negotiations happen when both parties come out of the meeting thinking they have got a win. Might not be the case, but they should both think it here that they have got a win. Negotiations never mean crushing each other. So anywhere between this is acceptable. Clear? Yes or no? More or less the entire topic is done. At least 75% of the entire topic is done. Write down now. Give me 5 minutes, I'll start dictating. X Limited allows its divisions to operate as decentralized, to operate as decentralized profit centers, full stop. Division A of the company produces a product which is sold in the external market at $60 per unit. Full stop. अरे प्राइस तो दिया हुआ है बाबा, $60, वही तो बोला है. Who was asking this question? Vishal. $60 per unit, full stop. Division B would like to purchase this component why will I say initial? I said initial. What have I did? Give me a copy. Arey, don't distract me because I'll forget. Unless ask your friend first before distracting me. I will totally ask your friends first before distracting me. Division B would like to purchase 3,000 units of this product from division A. Full stop. As they are both part of the same company, you as a management accountant have been asked to evaluate the feasibility of the proposed transfer. Full stop. Following are the details. Following are the details. Now write down this table. For those who have not written, now please copy down Following are the details, semicolon. Now note down this table. You guys had enough space. After writing this table, stop, huh? Tell me once the table is done. Done? Okay. Done? Everybody is done? Write down after this table an external vendor an external vendor ha- has quoted a price of $48 to the division B. Full stop. You are required to advise on the following. You are required to advise on the following, semicolon. Now write down the next three questions that are given. Once that is done, tell me. Done? Done? Copy this down. For those online, the second part, you can just copy this down. Question answer. Third, I will fully dictate. Mhm. I think it will take one more class because a lot of complicated theory questions are also there. Theory questions are way more difficult than numerical questions, especially based on chapters on numbers. Unless your concepts are clear, and out of 100 questions in the exams, at least 55, if not more, will be theoretical, but not plain theory like what is variable cost and all. Something like this they will test. So your concept needs to be very clear. Polish it every day. If your concepts are not clear, no matter how many questions you solve, no matter what you do, you will fail. Of course, you will struggle understanding it, but you need to, once you have understood it, you need to keep on revising the same. If you don't revise, you will forget. And if you don't understand or remember the concepts, it will not work out well in the exam because you will get similar questions but not same. Every attempt, your institute comes up with totally new questions. So if your concepts are not good enough, it will be pretty bad. So understand why we are saying that minimum transfer price is always the relevant, because below which A cannot go. A's manager cannot negotiate or cannot even think of going below it. Now, write down for the third part. Division A's Division A's manager cannot accept any transfer price below $35, comma, sorry, give first of all a bracket and write down relevant cost of manufacturing. See, whenever I say note, whenever I say bracket, I don't know if I've told you guys or not, change your pen or do whatever I can. I think I must have told you. I cannot keep on reminding it forever. Your copy, your notes. I told it in the first few classes only. The moment I say bracket, the moment I say note, write in cap, change the pen, use highlighter for all I care. Cost of manufacturing, bracket close. And the manager of division B, cannot pay anything more than the $48. Bracket, relevant cost of purchase. bracket close, full stop. So sir used to teach like this only, that 35 से कम, 35 मीन्स 35, 35 से कम वो लेगा नहीं, 48 के ऊपर वो देगा नहीं. Somewhere in between is the natural bargaining range. A will not accept anything below 35 and B will not pay anything more than 48. So natural bargaining range is this range. Full stop. Therefore, change the paragraph. Therefore, the natural bargaining range is 35 to $48. Take 5 minutes. Revise all this. I will solve few questions with you on this. Write down just one line. Remember that it's a very important note. Write down. Remember that transfer pricing is transfer pricing is always a price charged from one department of the company to another department of the same company. Full stop. There is no pattern. Each question will sing a different story. You have to understand the entire story before writing an answer. And this is only one example. I told you 2 or 3 I will need to give. But I want to solve first few questions on what I have discussed. अच्छा 1 minute before I start. Okay, so let me. Just 1 minute, everyone. I'm giving attendance. Huh? You guys continue. So only 4 people are absent, out of which 3 are always absent. Harish is absent. Mudassir is absent. Madhumita and Rakshita both are absent. ठीक. Division A of a company is currently operating at 50% capacity. It produces a single product and sells all its production to outside customers for $13. Variable costs are 7 and fixed costs are 6 at the current production. Division B, which currently purchases the product from an outside supplier for $12 per unit, would like to purchase from Division A. Division A will operate at 80% capacity to meet outside customer and Division B's demand. What is the minimum price that A should charge? I give you guys 3-4 minutes. If you are done also before it, don't start shouting because some people might need 2-3 minutes to figure this out. So figure it out. You are telling it's A. You have an answer? A. You have, okay, yes, sister. D. D.
B.
B. Oh, okay. अरे, anybody else whose answer is pending? So let me see. Relevant cost of manufacturing, $7. And relevant cost of purchase, $12. The minimum price which A will charge be $7. There is nothing in it apart from that. When they are saying that it will operate at 80% capacity to meet both the external sale and it's still below capacity. So, and it's unavoidable fixed cost. This was to not even a proper question. That is why we say write it down. Don't do it verbally. Do not be distracted. Write down every data like how I solve the question. Write down relevant cost of manufacturing. Write down relevant cost of purchase. And then only arrive at a decision. Clear? Where is the question telling you that you have to take any? They are telling you division B A will still operate only at 80% capacity to meet outside and division B's demand. Means still there is excess capacity. Or even if full capacity was there, what was the problem? The problem will only happen if there is above capacity. In that question, they will tell you the data. Overthinking complicates things. If your concepts are simple, if you can write it down, you also got it wrong, right? Horribly wrong. I am not shocked also because you did not, you overthinking. There is nothing to overthink in a simple question. An appropriate transfer price between two divisions of a manufacturer can be determined from the following data. There is fabricating division, marketing price of something called as subassembly, 50. Variable cost, 20. Excess capacity, 1000. Assembling division, number of units needed. What is the natural bargaining range for two divisions? Take 3-4 minutes because there might be people who will need time. Don't start shouting answers until I ask. I will ask the answer in the due time. Others are also there. If you have figured it out, sit patient. Everybody is telling it. It's simple. Actually, do not take this as representative of transfer pricing. The language will be way more difficult. See, something like this is a standard question. Something like this. Same theory only, but this will look like an actual question. How it is appear going to be. Lot of data, a lot more English language to comprehend with. This is the like starters. Not even proper starters, maybe tea and snacks, nothing more than that. And there is nothing for me to teach. Of course, one more example I will give. If you cannot, or if you are not willing to interpret the language, because in exam, separate question will come, English will be separate. Then you will again arrive at a different answer. I have taught you almost everything. Second example, I am covering now, which ends the topic more or less. Not ends because a lot of theory questions are there, which is quite complicated, might stretch up till next week. And remember, especially because in budgeting and all, there was no theory. In most of the numerical chapters, lot of theory questions come, which is based on concepts. Instead of asking calculate, they will asking how. So listen very carefully. And these recordings I have told you will disappear. Every month, maybe a month and a half, past data will keep on disappearing. whatever I dictated in example 1, copy the same thing, only change 2 lines. That's it. 3,000 will become, that's it. In this example, the topic will be 80, 75, 80% done. Same thing. Whatever I dictated that entire question, word by word, it should be same. Only 3,000 will become, yeah. Use the same language. X limited has 2 division and all. Same thing what I dictated there. Just instead of 3,000 in the table, write down 5,000. Should the transfer, everything is same. I told everything is same. Only 3,000 becomes 5,000. I gave you guys the language also. I dictated the full question. Same language use karo. Wherever 3,000 was written, transfer it to 5,000. Nothing else will change. Now, this is where the question gets interesting. This is a question that has to be solved in two parts. First, there is 3,000. This 5,000 units, there is two answers. Answer cannot change. First para will still be same. Of course, I'll give you time to note it down. Logic cannot change. The transfer should always happen if the relevant cost of manufacturing is less than relevant cost of purchase. Now, the company is making 7,000, 10,000 capacity. 7,000 they are already selling to the external customers. Now B wants 5,000. So there is first 3,000, which is excess capacity. For this, so for first 3,000 units, relevant cost of manufacturing is 35 and relevant cost of purchase is, yes, so first 3,000 to transfer should happen. For next 2,000, however, situation changes. Now, 3,000 can be given by A to B anyways, but 2,000 A can only give to B if it reduces its external sales. Now, in that case, there is an opportunity cost because A is already doing external sales to outside customers and it is making some money out of it. So avoidable fixed cost is still not given. They are not telling that capacity will increase now. So you have to assume they will reduce the existing sales. Now always remember in 99.99% of the cases, opportunity cost is always the benefit foregone. Benefit foregone means contribution lost because sales is not the benefit. Variable cost will also go. In making that product only, you are incurring variable cost. So it is always the contribution lost. In this case, the contribution lost is 60 minus 35. 60 is the selling price for which it is selling to outside customers and 35 is the variable cost. So 25. So if you look at it, relevant total becomes 60 only. This is also true for 99.99% of the cases. In all cases, actually 99, not all, 0.99, where company has to cut down existing sales to supply the product. In that cases, generally, minimum transfer price is the selling price, unless maybe company has to pay sales commission, and this unless is very important because this will be tested in MCQs. I will not be reading there out again. If you choose 60, that is your problem. That is why listening is very important. Unless maybe some savings can happen because the transfer is internal. Maybe packaging is not required. Same division, it's like same house. Go and throw away the product at their floor. Maybe sales commission will be avoided, not maybe. Who will pay sales commission to whom? A and B's manager negotiated. What will B say? I want sales commission. Or A say, I will sales commission. Management will throw them out. So sales commission to will always be avoided. But other, maybe delivery cost can be saved. If they are all in the same house or same factory only, you don't need too much logistics. Each question here will sing a different story. Question will tell you what to be avoided. That's why I said in 99.99%. But if that 0.01% questions or 1% questions, they will give you that sales commission was given in the question. You did not choose that. That's your problem. You are writing a professional exam. I am telling you for 5 minutes today that this will happen. Not today, most likely next Saturday. A question will come. If you are then reading it quickly and you cannot recollect, your problem. Because I'm already doing spoon feeding. Spoon feeding, which is acceptable because we were also spoon fed by our professors. In CA, if you are not spoon fed, there is no hope of survival. At 19 years old, you are studying accounting standards, CA, costing, finance, tax, the subjects which we have no understanding and no clue of. So we were all spoon fed. So I also do spoon feeding only. But then spoon feeding also, you have to be willing to eat that. If you throw it outside, I'm not going to again come. Note it down. Then we will go for a break. Come back. I'll finish at this. Which one? Next 2000 units can only be sold by or transferred by A to B if A cuts back on the external sales. Now that external sales is not excess capacity. A was earning something from it. Division A was generating some money for it. So there is an opportunity cost. Because A is giving to B, A cannot sell it to outside customers. And if he cannot sell to outside customers, that contribution has to be recovered from B. That is the meaning of opportunity cost. So in this case, while deciding the relevant cost, I need to remember that $25 is the opportunity cost also. Because if A would have sold it to external customer, A would have earned $25 per unit of contribution. No topic is difficult. Go with the flow, revise, understand. Don't overthink. Listen to me more than what you are listening to your friends. It's one of the finest batches I'm seeing perhaps in a very long time. Lot of you have the potential to become CMA. Maybe 14, 15, maybe even more. I know the numbers of the class also. So whether that will be fulfilled or not, it's all in your hands. A fine batch I define as someone who is willing to study. That's it. There is no other definition from my end. And who are consistent with their homeworks, classworks, revisions. And most of you do not understand your lives will change after you become a CM for the better. Hmm. Mhm. Are we done? Everybody, those guys are writing fast, you guys are writing slow, still you are talking. When the notes are not done, those have already written. Those guys also started writing after only. First bench, at least don't sit and talk. So write down for the first 3000 units, comma, relevant cost of manufacturing is less than relevant cost of purchase. Relevant cost of manufacturing is less than relevant cost of purchase, comma, therefore transfer should happen. Because logic is clear, it will increase the profits of the company. If you can make it at 35 in the inside, company is only benefiting from the transaction. Remember, both are parts of the same company. You have not even seen real questions today. Maybe next week you will see. Both are parts of the same company. So overall benefit of the company is more important. So when we are talking, we are only talking from company's point of view. In this case, it's beneficial for the company because if they buy it from outside, money spent will be 48. And again, sir used to say this very special line. All my students know it by heart. If I teaching you part 2, 10 times I will use this line. Sir again used to say this. पैसे का ना जाना भी पैसे का आना ही होता है. Money that does not goes out from your pocket is equal to money coming in. Sir used to always say this, that money saved and money earned are two same things. In this case, you are saving company money by doing internal transfer. It's like as good as you are telling you are earning company money. All my students, whatever thousands I have taught, they all know this line, whether I'm teaching cost or finance. And of course, I always credit sir first time in a batch. Because sir used to say this, it took us years to understand this line thoroughly. We also were noting like you only, sitting at 6:30 a.m. in the morning, half awake, half dead. But sir used to always keep on repeating, finance is this. Finance is understanding, it's not formulas. It's logic. Write down for the next line. For next 2000 units, same thing only. Write down for next 2000 units, relevant cost of manufacturing is greater than relevant cost of purchase. Therefore, transfer should not happen. Then we can have a break. Just write less than sign, make it greater than sign. Transfer should make it, transfer should not. That is the logical, na? Done? Let's have a break. Let's be back in 30-35 minutes.